They just killed the dollar. It's official, right now, today, Wednesday, January 28th, 2026. The United States dollar index just crashed to 95.566. That's a 4-year low, 4 years. The last time the greenback was this weak was back in early 2022, and you know what happened after that? Chaos. But here's what they're not telling you. Yesterday afternoon, January 27th, in Clive, Iowa, President Donald Trump stood in front of reporters and said, and I quote, "No, I think it's great. The value of the dollar's doing great. The dollar's doing great," while it was collapsing. While the DXY was plunging 1.3% in a single session, the worst one-day rout since April 10th, 2025, while the algorithms were panic selling, while the entire financial system was watching the reserve currency of the world get obliterated. And what did Trump say? "I think it's great." The reporter asked him directly, "Do you think the value of the dollar had declined too much?" And Trump, without missing a beat, said he'd want it to just seek its own level. He talked about how he used to fight with China and Japan because they wanted to devalue their currencies. He looked at the business America's doing and essentially gave the green light to sellers. Here's the timeline. Pay attention. Tuesday afternoon, January 27th, between 2 and 4 p.m. Eastern Time. Trump makes these comments during a press gaggle before his scheduled economic address in Iowa. The moment those words hit the wire, the algorithms went haywire. Steve Englander from Standard Chartered said it perfectly. When the president expresses indifference or even endorses the move, it emboldens USD sellers to keep pushing, and push they did. The dollar index accelerated its losses immediately after Trump's comments. It plunged to a session low of 95.566. That's not just a number, that's a signal. That's the market screaming that the emperor has no clothes. Over 3 days, from January 24th to January 27th, the dollar dropped 2.64% in 4 trading sessions. That's devastating. But let me put this in context for you. In the entire year of 2025, the dollar lost 9 to 10%. In the last 12 months, down 11.12%. And in January 2026 alone, down 2.3%. This isn't a correction. This is a controlled demolition. And while the dollar was burning, what was the financial media screaming about? Gold. Gold hit an all-time high of $5,266.38 per ounce at approximately 9:21 p.m. Eastern Time on January 27th. That's 2:21 a.m. GMT on January 28th. The Asian trading session saw it hit 5,262. Throughout the day on January 28th, gold has been hovering around 5,205 to 5,220 per ounce. Year to date, gold is up 20%. In the last 12 months, 83%. And every single financial news outlet, every bank analyst, every YouTube thumbnail is screaming the same thing. Gold to $6,000. Safe haven demand. Central banks buying. Record highs. Deutsche Bank just released a note yesterday, January 27th, 2026, raising their gold target to $6,000 per ounce by the end of this year. That's a massive upgrade from their previous forecast of $4,000 to $4,450. They even said in an upside scenario, gold could hit $6,900. Everyone is looking at gold, everyone is distracted, but they are lying to you. This video isn't about gold, it's about what they are hiding behind the gold headlines. Because while you've been watching gold climb 20% this year, another metal has been quietly moving 270% in 12 months. And the banks don't want you to know about it, they want it for themselves. I'm talking about silver. Stop, right here, right now. I need you to do something before we go any further. Before I expose what Deutsche Bank buried in their report. If you believe it's finally time for real money to defeat the fake paper dollar, hit the like button right now. Let's show the algorithm that we choose gold and silver over their failing system. I'm serious. Do it right now. Because YouTube's algorithm is designed to suppress videos like this, videos that expose the banking system. The algorithm wants to show you mainstream garbage. It wants to show you CNBC headlines and bank-approved narratives. But if we force the engagement metrics high enough, if enough of you hit that like button in the first few minutes of this video, we can override the suppression. We can make this video explode to everyone who's being distracted by fake news. So crush that like button, destroy it, and if you hit it, prove it. Comment "I did my part" below so I know who's fighting with me. So I know you're not just passively consuming. So I know you're actively resisting the propaganda. Comment "I did my part" right now. Let's go. All right, let's talk about the villain in this story, Deutsche Bank. On Tuesday, January 27th, 2026, they released a research note that sent shockwaves through the financial media. The headline, Deutsche Bank sees gold hitting $6,000 by end of 2026. $6,000. That's a 28% increase from their prior estimate. In their downside scenario, they see gold at $3,700. In their upside scenario, $6,900 per ounce. Their reasoning sounds compelling. They cite structural demand drivers, reserve managers reducing exposure to the threat of foreign asset freezing, investors seeking allocations to non-dollar and real assets, long-term projections of government debt growth, persistent investment demand, not episodic like the 1980s. They talk about central bank buying. They point out that reserve allocations have increased from 10% to 24% of the market since 2022. They say central bank buying since 2022 has not reversed. They talk about the weaker dollar thesis. USD 6,000 per ounce is achievable with a weaker dollar this year. They analyze historical patterns. When we look at sharp episodes of gold appreciation, we find that in 2/3 of cases, gold is higher still after 6 and 12 months. Every financial media outlet picked up this story. Gold to 6,000, gold to 6,000, gold to 6,000. But here's what they didn't tell you. Buried deep in that same Deutsche Bank report, the one everyone's quoting for their gold prediction, is a section on silver. And what does Deutsche Bank say about silver? They raised their silver target to $100 per ounce. That's a 71% increase from their previous forecast. 71%. But you didn't see that headline, did you? You didn't see CNBC running breaking news alerts. Deutsche Bank sees 71% upside in silver. No, they whispered it while they shouted about gold. And here's the smoking gun. This is what Deutsche Bank actually wrote in that report. Pay very close attention. A new investment flow has emerged since December. It's possible that reserve managers or sovereign wealth funds have opened allocations to silver, which would not be publicly known. Read that again. Which would not be publicly known. They are admitting that central banks and sovereign wealth funds might be buying silver, secretly, and we wouldn't know about it because they don't have to report it. Deutsche Bank continues. Silver prices are up over 260% since the start of 2025. 260%. Gold is up 83% in 12 months. Silver is up 270 to 292% depending on which data source you use. Silver has gained 3.5 times more than gold in the last year, 3.5 times. And yet, Deutsche Bank's headline is about gold hitting 6,000, not silver tripling, not silver outperforming gold by a factor of more than 3. Not the possibility of secret sovereign buying. No, they want you to look at gold. They even say in the report, unlike gold, silver still hasn't exceeded their real terms peak back in 1980. Think about what that means. Silver hit its inflation-adjusted all-time high in 1980. Gold has already blown past its 1980 level, which means silver has more room to run, which means silver is undervalued, which means silver is the better trade. But they don't want you to know that, because if you knew that, you'd do what they're doing. You'd buy silver, and there isn't enough to go around. Deutsche Bank also wrote, the gold-to-silver ratio could still support increases in silver prices, even if the adjustment occurs more slowly. The ratio. We're going to talk about the ratio in a minute, and when you see the math, your jaw is going to drop. But first, I want you to understand what just happened here. I want you to see the psychological manipulation in real time. A major global bank just released a report predicting massive gains in both gold and silver, but they marketed it as a gold story. They buried the silver story. They made sure the headlines were about gold, not silver. Think about the headline strategy. Deutsche Bank sees gold at $6,000. That's what ran on Bloomberg. That's what ran on CNBC. That's what ran on MarketWatch. That's the soundbite that went viral on financial Twitter. Nobody said Deutsche Bank sees 71% upside in silver. Nobody said silver outperforming gold 3-1. Nobody said sovereign wealth funds may be secretly accumulating silver. Why? Because the game is rigged. The game has always been rigged. Let me explain how this works. When a major bank like Deutsche Bank releases a research note, they know exactly how it's going to be reported. They know the financial media is lazy. They know reporters will grab the headline number and run with it. They know nobody reads past page 3 of a 40-page report. So they put the gold prediction in the executive summary. They put it in the first paragraph. They make it bold. They make it quotable. And then they bury the silver prediction on page 27 in a subsection without bold text, with hedging language like it's possible and could still support, and even if the adjustment occurs more slowly. This is strategic obfuscation. This is how you hide the truth in plain sight. Because here's what would happen if they led with silver. If Deutsche Bank sent out a press release that said silver to $100, up 270% with potential sovereign fund accumulation, every retail investor on planet Earth would buy silver. The COMEX would implode in 48 hours. The fractional reserve system would collapse. The paper contracts would be exposed as fraud. The banks holding short positions would be liquidated, and Deutsche Bank knows this. Every major bank knows this, so they distract you. They point you toward gold. They make gold the safe play, the responsible play, the institutional play, and while you're buying gold, they're accumulating silver. Because silver is the better play. Silver has already outperformed gold by 300+% in 12 months. Silver has the industrial demand. Silver has the supply crisis. Silver has the ratio compression. If retail investors pile into silver the way they piled into GameStop in 2021, the entire bullion system collapses. The whole rigged casino gets exposed. They need time to accumulate, time to position themselves before you figure it out, time to get their clients, the billionaires, the family offices, the sovereign wealth funds, positioned before the herd arrives. But you're figuring it out right now, because this isn't financial advice. This is a crime scene investigation, and the evidence is overwhelming. Deutsche Bank knows silver is the play. They're just hiding it from you while they load up. They're whispering to their private wealth clients while they're shouting about gold to everyone else. This is how wealth transfers happen. This is how the rich get richer. They get the information first, they act on it first, and by the time you hear about it, they're already selling to you at the top. But not this time. Because you're seeing it now. You're seeing the forensic evidence now. You're seeing the buried admission, the hidden target, the secret accumulation. Let me show you the math that changes everything. It's called the gold to silver ratio. And if you understand this number, you understand why silver is about to explode. Here's how it works. You take the price of gold and divide it by the price of silver. Right now, gold is trading around $5,266 per ounce. Silver is trading around $114.47 per ounce. 5,266 divided by 114.47 equals 46. The current gold to silver ratio is 46 to 1. That means it takes 46 ounces of silver to buy 1 ounce of gold. Now let me show you where this ratio has been. In early 2025, just 1 year ago, the gold to silver ratio was 100 to 1. It took 100 ounces of silver to buy 1 ounce of gold. Silver was that undervalued compared to gold. On January 10th of this year, the ratio was 56.4 to 1. On January 24th, it was 48.38 to 1. Today, 46 to 1. The ratio has collapsed from 100 to 1 to 46 to 1 in 12 months. That's a 54% compression. What does that mean in plain English? It means silver is catching up to gold, fast. And here's the thing. Historically, the gold to silver ratio doesn't stay at 46 to 1. It compresses further. In ancient times, the ratio was 12 to 1 or 15 to 1. That was the natural ratio based on the amount of silver in the Earth's crust compared to gold. In 1980, during the Hunt brothers silver squeeze, the ratio hit nearly 20 to 1. In modern times, the normal range is 50 to 1 up to 80 to 1, but we're at 46 right now, and it's still compressing. Let me run the numbers for you. If gold is at $5,200 and the ratio goes to 32 to 1, which is entirely possible based on historical precedent, what's silver worth? 5,200 divided by 32 equals $162.5 per ounce. If the ratio goes to 20 to 1, 5,200 divided by 20 equals $260 per ounce. If gold hits Deutsche Bank's target of $6,000 and the ratio goes to 15 to 1, 6,000 divided by 15 equals $400 per ounce. That's not speculation. That's math. That's what happens when the ratio reverts to its historical mean. And the ratio is already compressing. It's already moving in that direction. Fast. Silver is up 58.65% year-to-date in 2026. That's through January 28th, in just 28 days. Gold is up 20%. Silver is moving nearly 3 times faster than gold this year, and it's moved 3.5 times faster over the last 12 months. This is the snap. This is silver finally waking up. This is the market realizing that silver has been suppressed, manipulated, and undervalued for decades, and now the fundamentals are forcing it to correct. Stop scrolling. I need to know who's still awake. Check your watch right now. Tell me, what time is it and where are you watching from? New York? London? Sydney? Mumbai? São Paulo? I want to see the global resistance in the comments, because this isn't just an American story. This is a worldwide collapse of confidence in fiat currency. And silver is the global answer. Drop your location and the time in the comments right now. Let's see how many countries are represented. Let's see how many time zones are watching this truth get exposed in real time. Because what I'm about to show you next is the industrial panic that's driving this move. And it's going to blow your mind. Here's where it all connects. The weak dollar, the Trump comments, the Deutsche Bank distraction, the ratio compression. It all leads to one thing: an industrial supply crisis in silver. On January 1st, 2026, China implemented license-based export controls on silver. All silver shipments leaving China now require government-issued licenses. These licenses favor large state-certified producers and limit smaller exporters. Why does this matter? Because China controls 60 to 70% of global refined silver exports. That's 121 million ounces of annual silver exports now under Beijing's control. 121 million ounces. And overnight, that supply got cut off from London and New York. The COMEX can't refill its stocks. The London Bullion Market Association is scrambling. Regional fragmentation is happening in real time. Shanghai silver is now trading at a 10% premium over COMEX futures. 10%. That's arbitrage that can't be closed because the physical metal can't move. Why did China do this? Strategic rationale. They want to secure domestic supply for their solar panel industry, their electronics manufacturing, and their electric vehicle battery production. They're building the future on silver, and they're not letting it leave the country. But there's another reason, one that Deutsche Bank hinted at but didn't say out loud. Sovereign wealth fund accumulation. Unreported. China might be stockpiling silver at the state level, and we'd never know because they don't have to disclose it. Just like central banks buy gold and report it, China could be buying silver and hiding it. And while China is locking down supply on one side, the COMEX is getting drained on the other. In just 7 days, in early to mid-January 2026, 33.45 million ounces of physical silver were withdrawn from the COMEX. 33 million ounces in 1 week. That represents 26% of COMEX registered inventory, gone, vaporized. January 2026 delivery calls hit 9,181 contracts. That's 6.75 times the 2024 average, 6.75 times. Let me explain what this means. The COMEX is a fractional reserve system. It operates on the assumption that most futures contracts will be settled in cash, not physical delivery. They don't actually have enough metal in the vaults to cover all the contracts if everyone asks for physical delivery, and right now everyone is asking for physical delivery. In January alone, the demand for physical delivery equals 45.9 million ounces. Now let's talk about March 2026. The open interest for March, meaning the number of contracts that are standing for delivery, represents 528 million ounces of silver. 528 million ounces. The maximum convertible supply at the COMEX, meaning registered stock that can actually be delivered, is 416 million ounces. Do the math. 528 million minus 416 million equals 112 million ounces. That's a hard deficit. There isn't enough silver to fulfill the delivery requests if everyone stands for delivery. And the registered stock available right now? 114 million ounces. Total. Market analyst Clive Thompson put it bluntly, this deficit could constitute a force majeure event for the fractional reserve bullion system. Force majeure. That means the COMEX could declare a failure to deliver. They could change the rules. They could settle in cash instead of metal. They could blow up the entire paper silver market. And if January's delivery surge, which was 6.75 times normal, continues into March, we could see demand for 200 million ounces, completely obliterating the available registered stock. This is a squeeze. A real one, not a Reddit meme, not a pump and dump, a legitimate industrial supply crisis driven by sovereign export controls and institutional delivery demands. Let me explain what happens when the COMEX breaks. When too many people stand for delivery and there isn't enough metal in the vaults, the exchange has 3 options. Option 1, they declare force majeure and settle contracts in cash instead of metal. This means you bought a contract that promised you 1,000 ounces of silver, but instead of giving you the metal, they give you cash based on some arbitrary price they decide. You don't get your silver, you get paper, and the paper price is whatever they say it is. Option 2, they change the rules mid-game. They increase margin requirements. They limit position sizes. They restrict delivery. They do whatever they need to do to prevent the system from collapsing, even if it means screwing over everyone who played by the rules. Option 3, they let the price run. They let silver spike to $150, $200, $300 per ounce until the pain is so severe that industrial users and investors start selling their physical metal back to the market, refilling the vaults. Which option do you think they'll choose? If you said option 1 or option 2, you're correct, because the COMEX is not designed to deliver metal. It's designed to manage metal prices. It's designed to provide liquidity and discovery for large institutions. It's not designed to be a warehouse. But right now it's being treated like a warehouse, and the warehouse is running out of inventory. The January delivery surge is unprecedented, 6.75 times normal. And it's not retail investors causing this. It's institutions. It's industrial users. It's entities that need physical metal for manufacturing and production. These are the people who make solar panels, who make electronics, who make EV batteries, who make medical equipment. They need silver to exist, and they're realizing that the paper market is a lie. They're realizing that the contracts they've been rolling for years might not actually be backed by metal, so they're demanding delivery. And when everyone demands delivery at the same time, the system breaks. This is exactly what happened in the nickel market in March 2022. The London Metal Exchange had a massive short squeeze when a Chinese company couldn't deliver nickel. The price spiked from $30,000 per ton to over $100,000 per ton in 2 days. And what did the LME do? They canceled trades. They reversed transactions. They changed the rules to protect the short sellers. They destroyed trust in the market forever. The same thing can happen to silver. The same thing will happen to silver if this delivery surge continues. But here's the difference. Nickel is used primarily for stainless steel. It's industrial, but it's not critical to as many industries as silver. Silver is in everything: solar panels, electronics, medical devices, batteries, water purification, antibacterial coatings, semiconductors, 5G infrastructure, mirrors, photography, jewelry. You can substitute nickel in many applications. You cannot substitute silver in most of its industrial uses. The conductivity is too high. The antimicrobial properties are too unique. The reflectivity is too perfect. Silver is irreplaceable, and that makes this squeeze far more dangerous than any squeeze we've seen in commodity markets before. But wait, it gets worse. Silver lease rates just spiked to 8% annualized. 8%. Under normal market conditions, no rational borrower would accept such an expensive cost to lease silver. Lease rates spike when physical metal is scarce, when people need it now and can't wait, when industrial users are panicking. And they are panicking. Physical premiums are exploding. Shanghai is at a 10% premium over COMEX spot. Tokyo and Seoul premiums have soared far above spot price. Japan and South Korea, home to industrial conglomerates like Sony, Panasonic, Samsung, and LG, are engaged in panic buying. The market structure is breaking down. Arbitrage can't function because the quantity of silver that can actually be moved between regions is very limited. The paper-silver system's credit is fractured. Institutions are demanding delivery instead of rolling contracts. And here's the kicker: the reason industrial users are panicking. Samsung. Samsung just announced mass production of their silver solid-state battery starting in 2027. This is a game changer for electric vehicles. Solid-state batteries are safer, charge faster, last longer, and have higher energy density than lithium-ion batteries, but they require silver, a lot of silver. Here are the numbers: 5 grams of silver per battery cell, 1,000 grams, 1 kilogram, per 100 kilowatt-hour EV battery pack. That equals 32.15 troy ounces of silver per vehicle, 32 ounces per car. Current EV batteries use only 25 to 50 grams of silver per vehicle. Samsung's batteries use 1,000 grams. That's 20 to 40 times more silver per vehicle. Now let's scale this. Global EV production is projected to hit 80 million vehicles per year by the late 2020s. If 20% of those vehicles use Samsung's silver solid-state batteries, that's 16 million EVs per year. 16 million vehicles times 32 ounces per vehicle equals 512 million ounces of silver per year. Just for EVs, just for one technology, just at 20% adoption. For context, global annual mine production of silver is 820 to 850 million ounces. 512 million ounces for EVs alone would consume 60 to 65% of total global mine supply. If adoption goes to 50% of the EV market, that's 40,000 metric tons of silver per year. That exceeds total annual supply. If adoption goes to 80%, it consumes nearly all global silver output. And this is just one industrial use case. We haven't even talked about solar panels, electronics, 5G infrastructure, medical devices, or the hundreds of other industrial applications that require silver. The silver market has been running a structural deficit for 5 consecutive years. From 2021 to 2025, the cumulative deficit is 820 million ounces. In 2026, the projected deficit is 200 million ounces, and now Samsung is about to add 500 million ounce per year demand on top of that. Do you see the problem? Silver is no longer just a speculative asset. It's a critical resource for industrial survival, and there isn't enough of it. Electronics giants and EV battery manufacturers in Asia began panic buying the physical market in January 2026. The fear of production halts due to lack of silver is palpable. And while all of this is happening, while China locks down supply, while the COMEX faces a potential force majeure, while industrial users panic buy, while Samsung prepares to consume 65% of global supply, what is the mainstream media talking about? Gold. Let me summarize what we've uncovered in this investigation. On January 27, 2026, President Trump stood in Clive, Iowa, and said the dollar is doing great, while it was crashing to a 4-year low of 95.566. The algorithms panic sold. The dollar plunged 1.3% in a single session, the worst one-day rout since April 2025. Gold spiked to an all-time high of $5,266.38 per ounce, and every mainstream media outlet screamed, "Buy gold." Deutsche Bank released a research note predicting gold would hit $6,000 by the end of 2026. Their reasoning: central bank buying, weaker dollar, structural demand. The financial media ran with it: gold to 6,000, safe haven, record highs. But buried in that same Deutsche Bank report was a 71% price target increase for silver, a hint that sovereign wealth funds might be secretly accumulating silver. An admission that silver is up 260% since the start of 2025 compared to gold's 83%. And they whispered it. They buried it. They made sure the headline was about gold, because they don't want you to see the math. The gold-to-silver ratio has collapsed from 100 to 1 in early 2025 to 46 to 1 today. That's a 54% compression in 12 months. Silver is moving 3.5 times faster than gold over the last year. If the ratio compresses to 32 to 1, silver goes to $162. If it hits 20 to 1, silver goes to $260. If it reverts to its historical 15 to 1 ratio and gold is at 6,000, silver goes to $400 per ounce. But they don't want you to see the supply crisis. China locked down 60 to 70% of global refined silver exports on January 1st. 121 million ounces per year now requires government licenses. Shanghai is trading at a 10% premium to COMEX. The COMEX is being drained. 33.45 million ounces withdrawn in 1 week. January delivery calls 6.75 times the 2024 average. March faces a 112 million ounce deficit with only 114 million ounces of registered stock available. Silver lease rates hit 8%. Physical premiums exploded. Tokyo, Seoul, Shanghai, all panic buying. And Samsung's silver solid-state battery, launching in 2027, requires 32 ounces of silver per vehicle. At 20% EV adoption, that's 512 million ounces per year, 65% of global mine supply. And that's just EVs. That doesn't include solar, electronics, 5G, medical. The silver market has run a structural deficit for 5 straight years, 820 million ounces cumulative deficit, 200 million ounces projected for 2026. Silver is no longer a speculative asset, it's a critical industrial resource, and the vaults are empty. Trump killed the dollar. Deutsche Bank is distracting you with gold. But the real story is silver. The ratio is compressing. The supply is locked. The industrial demand is exploding. The COMEX is being drained. The paper market is on the verge of collapse. And while Wall Street talks about gold hitting 6,000, silver has already gained 3.5 times more and is staring down a genuine supply crisis that could send it to $150, $200, or even $350 per ounce when the ratio fully corrects. Don't listen to the banks. Look at the ratio. Look at the empty vaults. Look at the Chinese export ban. Look at Samsung's battery specs. Look at the COMEX delivery data. The evidence is overwhelming. They are lying to you about gold to distract you from silver, because if you realize what's really happening, you'll do what the sovereign wealth funds are doing, what Deutsche Bank admitted might be happening in secret. You'll buy silver, and there isn't enough to go around. So here's what I need you to do. If you're holding silver and you're not selling until the gold to silver ratio hits 15 to 1, comment diamond hands right now. Let me see who's in this for the long haul. Let me see who understands that this isn't a trade, it's a wealth transfer. Let me see who's not going to panic sell when the banks try to shake you out with a fake crash. Comment diamond hands. And if you're not subscribed to this channel yet, what are you waiting for? The next fake crash? The next bank-approved narrative that tries to liquidate your position? Subscribe so you don't get caught off guard. Subscribe so you see the truth before it's too late. Subscribe so you're not the one left holding worthless paper when the music stops. Because the music is about to stop. The dollar is collapsing. Gold is hitting records. But silver is the real story, and they are lying about it. This is John A.G. Live, protector of the retail investor, enemy of banking manipulation, and the crime scene is right in front of you.